Well, good afternoon, ladies and gentlemen. My name is Ethan Bredemine with AgriLogic Consulting. Along on this call, we have Brandon McDonald, Kim Harris, and Tom Blinn, all with AgriLogic as well. Welcome to part 3 of our Winning at Risk Management webinar series. Today, we're going to talk about actual production history programs for our annual and perennial crops. Welcome again to those who attended our previous 2 Winning at Risk Management webinars, along with those that have attended the Crop Insurance 101. And again, if you're new, we'd like to welcome you and thank you for attending this afternoon. We hope this is a great informational session to give you a good working knowledge of how some of these crop insurance programs work. I like to say the APH programs is kind of a Crop Insurance 102 presentation as well, because this outlines a good baseline of what we're looking at across the board, across all federal crop insurance programs. With that, let's get started. Again, I want to say before we get started, thank you again to our veterans who put their lives on the line for our freedom. Thank you again for your service. I don't think y'all get thanked enough. So I always want to start out these presentations by thanking y'all again for everything that you've done for us in our country. Real quick, we'll talk about AgriLogic Consulting. So who are we? We're a agricultural, economic, and insurance consulting firm. Our primary objectives is to develop, improve, and work on federal crop insurance programs as well as private crop insurance programs as well. We've had a successful record of developing several different programs on the public and private side. And then we also do a lot of economic and risk management analysis for companies. And then along with this risk management education like we're doing today. Diego and Nick and their crew at the Farmer Veteran Coalition is partnering with us on this educational project. And we can't thank the Farmer Veteran Coalition enough for all the great work that they've done helping put together these webinars and the in-person sessions that we had. We'll talk a little more about what we've done so far and what we have ahead of us. But thank you again to the Farmer Veteran Coalition. Also, with partners on this project is these webinars are funded and partnered by in partnership by the USDA Risk Management Agency. There's the verbiage there. Bill, Chola, and Brian have been great help throughout this process. So thank you again to Farmer Veteran Coalition and the USDA Risk Management Agency. So real quick, we'll talk about Crop Insurance 101, give you a quick overview of that. All these can be found on the Farmer Veteran Coalition YouTube channel. The Crop Insurance 101, as well as part 1 and part 2. And then this one is along with part 4 of our risk management webinar series. But farming, we know, is a risky business. And if we look at risk, it's made up of severity and frequency. And really, there's 3 ways that we look at mitigating risk, and that's to decrease the severity, to decrease the frequency of these events, or to transfer a portion of the risk over to another party, such as a crop insurance company. Well, if we look at different things, such as risk of cattle getting out, well, we can build the fence and work on that and making sure that those cattle don't get out. However, when we're talking about natural disasters, it's real hard to tell that tornado or tell that hailstorm to stop. We need you to not come across my wheat field or across my apple orchard. And so we look at, whenever we're looking at natural disasters, that third option to transfer a portion of the risk over into a form of insurance is usually a good option as far as risk management strategies are concerned. When we look at crop insurance, there's federal policies as well as private policies. They're both usually administered by private insurance companies. When we look at the federal side, and that's usually backed and premium subsidized by the federal government. And we see that most of our federal programs are what we call multi-peril. So we're covering a wide variety of perils and covered causes of loss, where our private programs are usually peril specific, such as crop hail or hail insurance that we see on the private side. And like I said, there are some, when we talk about our rainfall indexes and stuff on the federal side, those are a little more single periled. But in terms, and today when we're talking about APH programs, we're looking at multi-peril. So we're covering a wide range of adverse weather and other causes of loss according to that policy for that commodity. And when we look at the wide band of crop insurance, we can pretty much put those in 4 different buckets. We have individual based, so what happens on your operation; area based, so what happens in the area around you or in your county or given metrics from there. There's a blend between those two, so we call it a hybrid or quasi area and individual based. And in our rainfall indexes, We can call those in a parametric index. So what actually is happening across a grid or a different type of indice. So our objectives today is to summarize the benefits provided specifically for veterans, to discuss the components and characteristics of the federal APH programs, and provide examples of how some of these APH programs operate. There are 75 commodities currently that APH programs currently cover, and so it's hard to go too far into the details on each crop or commodity, given the extensiveness, and each program is a little different. So like I said, this is going to be a good overview. We'll highlight the annual and perennial crops. That's two really good categories to summarize these in. However, like I said, if you have any questions, please feel free to reach out to us when we're looking at crop specific, or reach out to your local crop insurance agent. So we'll go into the benefits for a veteran farmer and rancher. So qualifications: you must first be an individual who served on active duty in the military, and then that includes the reserve components, and then were discharged under conditions other than dishonorable. And then you qualify under one of these categories. I always like to say this is a three-step question approach. So the first question is have you operated a farm and ranch before? If you have not operated a farm or ranch, you qualify. If you have, we got to drop down to that second question. Have you operated a farm and ranch for more than 5 years? If you have operated it less than 5 years, you qualify. If you've operated a farm and ranch for more than 5 years, that brings us to question number 3. Have you obtained a veteran status during the most recent 5-year period? And so if you have in the most recent 5 years, you still qualify. If you have not, then you do not qualify as a veteran farmer and rancher. So like I said, 3-tier approach. First question, have you operated a farm and ranch? If you haven't, you qualify. If you've operated a farm and ranch for less than 5 years, you qualify. If you've operated it for more than 5 years, but you've obtained your veteran status in the most recent 5 years, you qualify. So those are the 3-tier metric as far as qualifications concerned. Businesses, if I'm partners with others, each one of us has to qualify as a veteran farmer and rancher in order for this business or partnership, or however your business is structured, to qualify, as that each beneficial interest holder must qualify as well under a veteran farmer and rancher. However, your spouse status does not impact. So if I qualify as a veteran farmer and rancher, but my wife does not, I still qualify as far as a business. So spouse, basically the spouse veteran status is waived, does not impact your eligibility. So what are we looking at from a benefit perspective? I get to enjoy the APH programs because we'll get to go into each one of these different categories a little further than we've seen in the first 2 webinars. So one benefit is that you're exempt from your administration fee on catastrophic coverage and buyout coverage policies. We'll talk a little more about this, but that's huge savings there. We increased the premium subsidy for buyout policies by an additional 10%. You have the opportunity to use a previous producer's production history records, as long as that acreage is for acreage that's transferred to you, as long as you have permission by that previous producer and you were actively involved in that operation. And then we get to talk about yield adjustment, which basically substitutes a low yield. Typically, when yield adjustment happens at 60% of the T yield, as a veteran farmer and rancher, that's increased to 80% of the T yield. And we'll talk more about this here shortly. So beginning farmer and rancher are the exact same benefits that we see in our veteran farmer and rancher status and qualifications. On a beginning to qualify, we must have operated a farm and ranch for no more than 5 crop years or 10 crop years if we elect whole farm revenue protection. We talk more about whole farm revenue protection in part 1 of this series. So if you have some questions about that, go to that on the Farmer Veteran YouTube channel. Crop years are excluded if we were either under 18 years old, enrolled in post-secondary studies, or in active duty in the U.S. military. So essentially, if I helped my dad on a farming operation at 16, I farmed 16, 17, 18, went off to Texas A&M for a few years and then come back. None of those years count towards my qualification status of being a beginning farmer and rancher. Therefore, I would still qualify because those years are essentially waived from counting towards my 5 crop years. And so I still have 5 crop years to still qualify and be qualified as a beginning farmer and rancher. Again, the same thing if you're a business, each business entity must, or each person in that business must also qualify as a beginning farmer and rancher in order to qualify. So limited resource farmer and rancher are available to those who have a direct or indirect gross farm sales less the index value. So that's a little over 220,000 for this year. And less of those each of the two previous years. And then your household income must be below the national poverty level for a family of four, or less than 50% of the county median household income for each of those last two previous years. This is kind of a different trying to understand if you qualify or not. The best thing is USDA publishes a limited resource farmer and rancher determination tool. There's the link below there. Click on that, go through the steps. And if you qualify, there's financial and technical assistance programs available through our USDA programs. However, like I said, it's out there and a great benefit if you qualify under this. With that, I don't see any questions, so we'll roll right on into APH programs. So when we look at it across the country, there are APH programs found in all 50 states. Again, depending on the commodities, we're looking at 75 commodities that we're covering. When we look at this from an insurance experience status, that's a little over 56,000 policies earning premium. And when we look at that from an insured acres, that's over 10 million acres that were insured under APH plans. When we're looking at coverage of liability, that's about a little over $17 billion. When we look at this across the country, like I said, depending on the commodities in your area, it all depends on where you live and what commodities are available. When we look at that from our top 5 states in terms of liability, California, Washington, Minnesota, Idaho, and North Dakota encompass our top 5. Again, they are found throughout all 50 states, depending on, not all commodities are found in all 50 states, but commodities in those different regions, there are APH plans available. So when we look at terms of what are we looking at in the top policies earning premium, we can see sugar beets, followed by grapes, forage production, which is our alfalfa, and oats and almonds round out your top 5. In terms of insured acres, we see the $1 Million Club is our forage production and our sugar beets. Almonds is a real close third, falling just below that $1 million million insured acres. And then potatoes, sugarcane, grapes, oats, millet, flax, and apples round out your top 10 in terms of insured acres. In terms of liability, almonds by far is a high-valued crop and dominates in our APH plans. Grapes, apples, potatoes, sugar beets round out the above $1 billion club in terms of liability. When we look at premium, apples dominate this, with grapes getting real close to over 100 million in premium. Potatoes, almonds, sugar beets, pistachios, flue-cured tobacco, peaches, blueberries, and forage production round out the top 10 in terms of premium. So I'll give you just a second to look at the different commodities. As we can see, there's 3 slides of these different commodities. Things to highlight, we'll highlight those in the next slide of some different changes that we're seeing here in the foreseeable future. But anything from alfalfa seed to buckwheat to figs to flax to grapefruit, grapes. Here's the second slide. I want to highlight kiwi fruit is coming soon in the 2024 commodity year. And then also oats and rye will be switching over to you can see those acronyms there. Those are revenue protection with harvest price exclusion, and yield protection. Oats and rye will be rolling over to those types of plans starting in this year in the 2023 crop year. However, they have been available as APH plans. So we can see, like I said, we go from onions to prunes, pumpkins, sesame, silage, sorghum. And then here's that last slide from sugar beets, sugar cane, sweet corn, tangelos, tangors, tomatoes, triticales, and walnuts. There's a lot of different commodities that we cover, so it's hard. We don't have quite the time to dive into each one of these commodities and the details. But like I said, we'll give you that big overview of how most of these programs operate, depending if it's a perennial or annual crop. So what are our reports looking like? So we first have our application. So that's basically your information and your coverage elections. So what commodity are we covering? What's our coverage level looking like? What's our share percentage in that crop? Next, for perennial crops, there's a producer's acceptance worksheet. This is essentially a self-certification stating what the condition of the grove is or orchard is. Basically making sure that we can produce a crop, that the trees are in good shape and that they're well managed and taken care of, and that we can produce a crop year in and year out for our perennials. If that the insurance company will take that PAW, that we call it, or producer's acceptance worksheet, and if they see that further inspection is needed, that's usually what we call a pair. Basically, insurance company gets to come out and inspect it as well and make sure that everything that producer put on that PAW is credible and accurate, and make sure, like I said, that those groves are in good condition and those trees are in good condition in order to produce a good crop. So our production report, we're looking at approved yield. So year in and year out, you'll turn in a production report, whether you had a loss or not. And so that adds to your APH, your historical yields, and we'll talk about that here shortly. And in our acreage report, so basically that's how many acres we have, and that will be utilized to calculate our guarantee premium and liability. So here's some important dates. I won't go through all the ins and outs of each of these dates, but our sales closing date, that's the most critical one. That's when our application needs to be turned in for that crop. I want to highlight, we talk about different planting dates. That's when the plant must be in the ground. And in acreage reporting, of course, we've talked about that. Premium billing is the earliest date that an insurance company can bill you for insurance for that year. So that's a key point to make there. And then, of course, end of insurance is when that coverage ceases for the crop year for that given commodity. So we'll talk a little bit about premium and subsidy. So what is our premium subsidy? Well, that's the amount paid by the federal government. Again, if you're a beginning or veteran farmer and rancher, that adds an additional 10% subsidy level. So that table that you see there below, that's a general subsidy schedule that we see across all of these commodities for the most part. And as we see that CAT right there, that's catastrophic coverage. We'll talk about that here shortly, but that's completely subsidized. But it is pretty much catastrophic coverage for the most part. However, give you an example, if I elect 65% coverage level as a basic unit, which is that BU there that you see on the left-hand side. So 65% coverage level basic unit, that's a 59% subsidy. If I qualify as a beginning or veteran farmer and rancher, that's increased to a 69% subsidy. So that's you sit there and you go, well, 10%, that's not a lot. But when you start putting a pencil to it, that can be a huge savings for you. One thing also to highlight here is you need to go to your local farm service agency or FSA office and make sure that you get this AD 1026 form filled out. Basically, that's making sure that all compliance is made with highly erodible land and wetland conservation regulations. It's important to get this form filled out or you will not be eligible for subsidy. So this form needs to be filled out in order to be eligible. And like I said, go to your local FSA office and they know they know about this form and what it highlights. And so should be easy and they should be able to help you out there. Make sure that this form's filled out in order to make sure that you get your subsidies. So administration fees and subsidies, as we talked about, are buy-up coverage levels. So that's anywhere from 50 to 75% and 5% increments. Some commodities we're looking at 80 and 85% coverage levels as well. In those, when we're looking at administration fee of $30 per crop per county. And in that CAT coverage, so it's completely subsidized, but they have to increase that administration fee to $655 per crop per county. Again, if you're a beginning or veteran farmer and rancher, you're exempt from these administration fees for buy-up and catastrophic coverages. So that's a lot of savings there as well. Again, you don't have any administration fee unless there are insurable acres. And again, same thing, we're going to talk about premium based on your liability that you have under that policy. The biggest thing to highlight here is it doesn't matter what insurance company you go to, as far as federal programs are concerned, the premium rate's going to be the exact same. So everybody's on the same playing field across insurance companies and across agents. So if you're looking at two different types of cost, when you're comparing, they should be the exact same. You got to look at that because, like I said, we're not comparing the same elements, because if all components are the same across all companies, our federal crop insurance policy should have the same rates that we're looking at. Again, no insurable, if you don't have any insurable acres, no premium is due. So APH programs, we're looking at covering yield losses due to naturally occurring perils. We are not covering a decline in price. The price that's established, RMA establishes these prices at the beginning of the crop year, commodity year. That's the price that we're looking at from beginning to ending. Based on the average historical years, so your most recent 4 to 10 years of experience, and it's at average, there are some adjustments that we'll talk about or enhancements to that average yield, but that's what we're looking at, actual production history. Producer insures a percentage of your approved yield. So again, that's at 50 to 75% and 5% increments. Some crops do go up to 80 or 85% coverage. And then lost production is paid at, again, that RMA established price that we were talking about. So coverage, basically my guarantee makes that approved yield, so that 4 to 10 year average multiplied by that coverage level. And again, like I said, we're 5% increments, 50 to 75%. So we'll use the example. I produce 10 pounds per acre is my average yield. I elect 75% coverage level. The price is $1 per pound. I elect 100% price selection, and I have 100 acres of it. So pretty easy math. I take that 10 pounds, multiply it by $1, so that's $10 an acre. I have 100 acres, so my total crop value is $1,000. If I elect 75% coverage level, I'm essentially insuring $750 of that crop. My deductible is at 25%, or $250. So anything that falls below $750 is insured. So going back to that crop insurance 101, I'm basically, this is helping me make sure that the worst I can do is a $250 loss. Anything else underneath is covered. So we'll talk about CAT coverage. So that's 50% coverage level at 55% of the price. And that's the only option that we're looking at from like I said, from a CAT coverage perspective, but it is 100% subsidized, but my administration fee is increased from $30 to $655. However, beginning or veteran farmer and rancher, you don't have to worry about that because those are waived. We'll take this same example, except instead of 75% coverage, I elect catastrophic coverage. So now my catastrophic price, instead of being $1, that established price is $1 a pound. So I'm going to take 55% of that for being my catastrophic price. So I'm looking at 55 cents per pound. So while my crop value is still that $1,000, I elect 50% coverage, and being because of the price and the coverage level that I elect, only $275 of that value is actually insured. My deductible, we're looking at about 72.5% or $725. So we're going to go into units. You heard me talk a little bit about using basic unit as that example when we were talking about subsidy structure. This is a good thing to just study and continue, but we have basic units, optional units, and enterprise units. And there's different ways that we can divide it. I want to go, easier way to explain it that helps me is looking at it from a table perspective. So we have 5 fields. Fields 1 and 2, I have 100% share in. Fields 3 and 4, I'm partners with Tom on. And in field 5, I'm partners with Bill on. And so we can see that there's above and below guarantees. So that's what it was. If field 1, I produced $14,000 above my guarantee. So we're using these as an example. If I broke it up in the basic units, so basically in the 5 fields that I have 3 basic units because it's all depending on who I have a share with. So of course, 1 unit is the share I have with myself only. So that's fields 1 and 2. Then I have a second basic unit, which is the fields that I have a share with Tom in. So that's fields 3 and 4. And then that third basic unit is the field 5, which I have a share with Bill in. Optional units breaks that up further. So basically that's field by field. So I have 5 fields. I have 5 different optional units. And like I said, there's a lot of different metrics depending on how we break up our optional units and these different unit structures. However, this is a good, like I said, good overview of how that works. Enterprise unit is everything across the board. So all 5 fields put in together is 1 unit. And so we can see that breakout there at the bottom in this example. My optional units, I'm having a higher indemnity. And basically you see that. Why is that? Well, we also see that like enterprise units and basic units, there's usually a premium discount because I'm compiling fields together. So we see basic units, we're putting fields together by share. Enterprise units, we're bundling everything up. And so we're allocating, we talk about put eggs in one basket. So enterprise unit, I'm putting my risk across the 5 units instead of taking it from a field by field basis, which we see in our optional units. So we'll go into that approved yield. So that's that average, simple average of the most recent 4 to 10 years of your actual yield. So what's happening on your operation. However, depending on crop share, participation, management, and physical activities required to produce a crop, and then perennial, for our perennial crops, you can use a previous owner's yields. And we talked about that second bullet point. If you're a beginning or veteran farmer and rancher, you have the opportunity to use a previous producer's actual yields, as long as you were active and that person gives you permission to use those yields. If you do not have availability of the most recent 4 years, there is a thing we call transitional yields. So those are basically conservative yields established by crop, by county. And it's a variable structure that we have for those that fill us in the gaps for those missing years. And we'll show you an example of that right here. So let's take, for example, I do not have any previous yields. So I'm going to get to use 65% of the transitional yield. If I only have 1 year of actual records, I get to increase that T yield up to 80%. 2 years, I increase it to 90. And then if I have 3 years of actual yields, I get to use 100% of the T yield for that missing gap. Now, I will say if you're a beginning farmer and rancher, there are opportunities and options available depending on the program that you can use 100% of the T yield, even if you do not have any records. We understand you're coming into the program fresh. You don't have any previous yields. Like I said, if you qualify as that beginning producer, depending on the program and how it's structured, most of the time you increase, instead of having to use 65%, you get to use 100% of the T yield. So like I said, a lot of great benefits there. And like I said, this all depends on the commodity and how it's structured. Some programs, you must have grown the crop for a few years or 1 or 2 or 3 years in order to qualify. And so have to look at the policy. And again, best resource is your crop insurance agent when we're looking at crop specific details. So we'll highlight yield enhancing options. So these are policy features that help us increase that approved yield. Again, these are not available on all crops, but here's some different options that we see across the different programs that are out there. So there's a yield floor that basically prevents the approved yield from dropping below a specific percentage of the T yield. We have our trend adjustment. So hopefully year in and year out, we're improving our practices and we're getting better, which is producing higher yields. So there's the ability to see that trend and inflate those historical years to make sure that, hey, hopefully this next year I'm doing better because over the last 5 years, I've continued to improve on my practices and resulted in increased yields. And so there's opportunity there. Yield substitution. So we'll talk about that 60% of the T yield for years that I have low yields. And then beginning farmer or veteran farmer and rancher, we see 80% of that T yield being utilized. There's a yield cup. So basically that helps from a 10% decrease. It basically limits it, where the next year my approved yield cannot go less than 10% of the previous approved yield. And in yield exclusion, basically if you have a bad year, say a hurricane comes and wipes out a lot of the area, this yield exclusion is sometimes applied to make sure that, hey, we're not even going to look at what happened that year because we know it was a great loss for your operation as well as across the area. It is important to note that this yield exclusion is depending upon what happens in the area. So if a hailstorm comes and affects my field, this is probably not going to apply. However, if we see, the hurricanes we've seen this previous year or a huge drought across the country, we see that, or across your given area, this yield exclusion will apply likely, depending on the crop. To give you an example of how this works, These are grapes in New York, I believe. There's my actual yields for the year. We can see that 2023 year, I only produced 1.3 there. So that was a pretty bad year for my operation. But here are my T yields that I see. So across the board, we're looking at 3.6 there. If I look at yield adjustments, so instead of having a 1.3 in 2023, I get to use 60% of that 3.6, which arrives me to a 2.2. And we'll look over there in that average. I go up from, if I used all my actuals, I had a 4.1 average. Well, now with yield adjustment, I inflate that to a 4.3 for the 2024 year. Yield exclusion, so say really bad event happened that affected across the area and yield exclusion gets to be applied. I get to waive that 1.3 and my average increases from a 4.1 average to a 4.8 average. And then yield cup, which is at 90% of the prior yield. So if we were looking at my average from 2019 to 2022, whenever I was going into the 2023 commodity year, I get to use 90% of that average and make sure anything less I sustain. So we're looking, when I went into 2023, my average of 2019 and 2022 was a 4.8 approved yield. So 90% of that arrives me to a 4.3 as well. So again, going back, instead of having a 4.1 average going into 2024 with yield cup, I have a 4.3 average. So a lot of different enhancements and options that we have here. These are just some to give you a good idea of how some of these different options work. Again, depending on the program and commodity that we're looking at in your area, depends on if these options and enhancements apply. So claim settlement. So event happens, natural occurring event that's a covered cause of loss. I must submit a notice of loss in order to be covered for that. When my production account for that year falls below the guarantee due to that covered cause of loss, and indemnity is likely to occur. Depending on when that cause of loss happens, there's appraisals and what do you harvest out of that year. And depending on how that works for that year, given the covered cause of loss and given the commodity, again, essentially, it all depends there, but essentially when that production account is below my guarantee, that's when a loss occurs and indemnity is available. We talk about the appraisals can be used in conjunction to make sure, all right, what would have this produced if we could have continued on, and depending on, like I said, what that cause of loss is. So let's go through some examples. I think we are covering our questions. Thank you to the group there for covering the questions. Let's go into examples. We're going to cover a perennial crop, and then we'll go into a perennial crop, but electing cat coverage, because I know, especially when we went out in live sessions, catastrophic coverage was a good thing we needed to understand. So we'll go through that, and then also our annual crops and give an APH example of an annual crop calculation. So let's take peaches in Edgefield County, South Carolina. I'm a producer there, and I have 10 acres of peaches, and I elect the APH program. So my guarantee is 200 bushels an acre. I elect a 65% coverage level. My established price is $29, a little over $29 a bushel. And I have 100% share in the crop. So when I look at my guarantee, I take my 200 bushels, multiply by my coverage level, by my acreage, and by that established price. And I'm looking over a little over $38,000 in production guarantee. Let's say when an excess rainfall caused damage to my crop, those are covered causes of loss. And for that year, I only produce 1,100 bushels. And so I'm going to take that 1,100 bushels, multiply by that same $29 established price, and I get a little over $32,000 in value of production account. I take the difference between my value of my production guarantee from that value of production account, multiply it by my share, and we can see here I have a little less than a $6,000 indemnity. Pretty easy there. So we'll go into perennial crops, but with catastrophic coverage elected. So I'm in Hidalgo County, and I produce grapefruits. I have 25 acres of grapefruit, and I elect the APH program. My yield is 15 tons an acre. I elect catastrophic coverage. Again, that's 50% coverage level at 55% of the price. My established price is $200. However, I'm going to multiply that by the 55%. And so my catastrophic price is $110 a ton. I have 100% share in the crop. So as we can see here, I'm going to do the same thing as the prior example. Take 15 tons, multiply it by the coverage level, which is 50% for cap, multiply it by 25 acres. And then instead of using that established price, I use my catastrophic price because I have cat elected. So that's $110 a ton. So my value of production guarantee is a little over $20,000. So if we look, the overall, if we use the $200 established price, that crop value is $75,000. However, what is my coverage? Because I elect cat coverage, well, that's a little over $20,000, just to show how the dynamics work. So let's say freezing cold weather caused severe damage to the crop, and I only produce 50 tons that year. So I'm going to take that 50 tons, multiply it by the catastrophic price, which is $110 a ton, and that results in a production account of $5,500. I take the difference between my guarantee and the production account, multiply it by my share, and I have a little over a $15,000 indemnity. So as we can see here, and again, to summarize catastrophic coverage, 50% coverage level at 55% of the price. But it's 100% subsidy. And if you're a beginning or veteran farmer and rancher, that $655 administration fee is waived. However, I will say that catastrophic coverage is pretty much what it is. It's a catastrophic event needs to occur, or probably needs to occur in order for it to trigger, because it's such a low amount that we're covering. However, it is good coverage that's relatively affordable when we look at subsidies and the benefits that we see from beginning and veteran farmers and ranchers. So we'll go into an annual crop. Let's take hemp, for example. I'm in Valley County, Montana. I have 80 acres of hemp and elect the APH program. My yield is 330 pounds an acre. I elect the 75% coverage level. The established price is 55 cents a pound. And I have 100% share in the crop. I take my yield, multiply by my coverage level, by the acreage and established price, and I have a little less than $11,000 of value of production guarantee. Let's say a hailstorm comes and causes damage to my crop, and I only produce 16,000 pounds that year. I take that, multiply by the 55 cents, and I have about $8,800 value of production account. Take the difference between my value of guarantee and my production account, multiply it by your share, and you have a little over a $2,000 indemnity there. So that's a quick example of how these different APH programs work. Like I said, this is a good foundation when we go further into like revenue protection and yield protection. This is always a good starting place when we're training individuals. It's good to understand how APH programs operate. There's a great resource here, the Actuarial Information Browser USDA publishes. You can find on the website, on the RMA website. I don't know if you'll be able to see the image there, the screenshot there, but you can look at different types and practices, your unit structures that are available, the price, of course, that's the established price, what the transitional yields are looking like, dates, rates, subsidy factors, some different provisions and other options depending on the crop. For example, this one's almonds in Fresno County, California for the 2023 commodity year. Like I said, a good resource to look at. And if you have some questions about what grapes are in my area, what's the unit structure look like, or if I'm looking at pistachios, A, is it covered in my county, and B, what's the established price for pistachios, or whatever the case may be. Again, your local crop insurance agent, I will say, is a great resource as well, and we'll talk about that here shortly. There's some different finding the different policies. There's a link to it that RMA publishes. Again, Kim always talks about this. Your local crop insurance agent is probably your best source when we're talking about these different things. It's good to have a crop insurance agent that has the heart of a teacher. They can make your life a lot easier or a lot harder depending on how good of an agent they are in teaching you how these different policies and programs work. RMA publishes a crop insurance agent locator that's good to utilize. I'll also say your local farmers and ranchers are a great resource. They know usually who's good agents or bad agents, or who to contact to find a good crop insurance agent. And so, like I said, those are two great resources there. And then we're based here in College Station, Texas, and do a lot of work at Texas A&M University and the Department of Ag Economics, as well as the McFerrin Center for Entrepreneurship. There's an entrepreneurship boot camp for veterans. I believe the head university in putting this program together is Syracuse University. There are 8 different schools that have this program: Texas A&M, Florida State, LSU. I think St. Joseph's in Philadelphia has this available. University of Connecticut and University of Missouri, and there's a few others that are not off the top of my head that I'm thinking of. But it's a 30-day online course and then a 9-day residency on one of these schools, and it's completely free training. And basically, if you're trying to start up a business, start up your farm and ranch, whatever the case may be, it's no cost training for veterans. And so this is a great opportunity. Just wanted to share it. Thought it's a great resource. If you're interested, there's a link there that you can reach out and find more information about. So we see this as part 3 of our webinar series for Winning at Risk Management. Back in January, we started with a Crop Insurance 101 webinar, had a great feedback on it and a great utilization on how different crop insurance programs work, gave that 30,000-foot approach. Then in February and March, myself, Kim, and another one of our policy analysts went to Tennessee, North Carolina, and Texas and had Crop Insurance 101 presentations as well. And then we started with this Winning at Risk Management series with part 1, which goes into whole farm revenue protection and micro farm programs. Then in the end of April, we had part 2, which is apiculture and PRF programs, so our rainfall indexes. And now we're in part 3. Again, all these parts will be found on the Farmer Veteran Coalition YouTube channel. And we'll go here in a couple of weeks to part 4, which will be our livestock programs. Really excited about these and talk about the different programs that are available for our livestock producers. And then after we conclude with that, we'll go into this summer and hopefully put together some training modules that basically highlight the key points of our Crop Insurance 101 and this Winning at Risk Management webinar series, and get to go into a little more breakdown of, what was that again about subsidy structures, or what is it that qualifies as a veteran farmer and rancher? Well, instead of having to go through all these presentations, we're hoping to come up with the modules that you can click on and work with and say, all right, this is how those subsidies work. Or what was that about premium again that I was trying to think about, how the administration fee works or something. You can hopefully click on those and have more of a breakdown of those training modules. With that ends our presentation. Again, thank you again to USDA Risk Management Agency and the Farmer Veteran Coalition on helping us put together these great presentations. And again, thank you for attending. And we'll open the floor to any questions. Again, reach out. There's our contact information there that you can find. And again, I want to say thank you again to the veterans, and thank you for being a part of the agricultural industry. This is one of the greatest industries that we can have and be a part of, that helps provide the feed, food, fuel, and fiber for the world. So thank you again for being part of the agriculture. And again, thank you for your service for all of our veterans. Thank you again, and hope you all have a great day.